Good evening, everyone. Thank you all for joining us. While we wait for the rest of the participants to join, please feel free to download the 360 mobile app and explore its real time features and updates on the latest happenings and its solutions. Good evening, ladies and gentlemen. I'm Akshata Purohit, and we are delighted to welcome you all to today's Business Unplugged session, a platform where thought leaders from across the globe come together to share insights and spark conversations that matter. Thank you for joining us today for what promises to be an insightful discussion on shaping the future of receivable finance, insights, innovations, and imperatives for corporates. We are proud to host two distinguished experts, Mark S. Mandula, Chief Learning Officer at BCR Publishing, in conversation with Kunjan Kapadia, Head of Banking Alliances and Investment Banking at 360TA. We are pleased to welcome Kunjan as the moderator for today's Business Unplugged session. A CFA charter holder and Penn State alumna, Kunjan brings nearly 2 decades of leadership experience across the financial services sector. She has worked in key markets such as the UAE and the US, leading strategic initiatives in asset management, investment banking, corporate finance, portfolio management, and banking strategy. Over the years, she has driven high impact capital market transactions and championed the strategic use of technology to address evolving challenges in trade finance. Now, let's introduce our guest of the evening, Mr. Mark S. Mandula. Mark is a globally recognized expert in factoring, author, speaker, and seasoned entrepreneur with over 2 decades of experience in commercial finance. As Senior Vice President and Managing Partner at United Capital Funding, he led the firm to scale 80-fold, reaching over $1 billion in net funded exposure. He now serves as Chief Learning Officer and Equity Owner at BCR Publishing, where he drives global learning initiatives and industry events. Earlier in his career, Mark played a pivotal role in over 200 bank merger and acquisition deals and served as CEO of a leading credit industry firm. A respected thought leader, he has spoken at more than 250 international conferences and contributed over 2,000 articles to top tier finance publications. I'm sure everyone is eager to hear their thoughts and insights. With that, I now hand it over to the panel to drive the discussion forward.
Thanks, Akshita, for that wonderful introduction to Mark. Welcome, Mark, to Business Unplugged. It's an absolute pleasure to have you.
Pleasure to be here.
For everyone, this is a special treat. Mark is one of those rare individuals. Whenever he's invited to speak, either at a conference or in a panel, he comes very well prepared. He has infographics, he has presentations. For this one today, unfortunately, there's no presentation, but the dialogue with Mark is going to be very, very interesting from the perspective of invoice factoring open account. So we'll get right into it. The discussion is structured around broad themes like strategic value and business impact, innovation, technology, as well as risk management, compliance, etc. So we get into some of those interesting topics right away. So Mark, very simple question to start off with. Why is receivable finance becoming increasingly important in today's business environment for corporates?
Well, good morning, and thank you for the opportunity. It's a pleasure. And I think what's interesting about the initial question is that we have had, even this year alone, so many dynamic shifts in the global business and economic environment that it's made receivables finance and this entire sector even more important. And there are probably 8 or 9 different reasons why, right, the way I could answer the question. But the first is when you think about what's happening in the world economy and then a regional economy or even within a certain economic bloc like the EU, we have inflation, we have rising interest rates or stable interest rates, we have supply chain disruptions, primarily because of the tariff issues. So now more than ever, the ability to have liquidity without taking on additional debt is more important. And as a result, the receivable finance products that we're going to talk about are really the perfect solution or one of the perfect solutions to deal with that. The second, of course, is that the supply chain resilience, which was tested during COVID, is certainly being tested again based on the tariffs and the issues related to the supply chain. And so again, the entire receivables management, receivables finance tools allow each sides of that equation to have some flexibility, which so they otherwise wouldn't have. The third reason, and this is an important one, which is when you think about the corporate treasury strategy today, it's got to be reducing sales outstanding. And one of the ways that you can do that is by either factoring, which is purchasing a receivable at a discount, or securitization. And more companies are moving to a securitization, and it's becoming not a mainstream product, but certainly institutional capital, global institutional capital is increasingly interested in this as an asset class. Matter of fact, there was just a meeting in London, and there's another one coming up this fall, talking about how and why this is a very attractive asset class for an investor. The next reason behind the entire push for receivables finance is digitalization and fintech have enhanced the accessibility and the efficiency of the entire industry. You think about AI, credit models, automated invoice validation, blockchain. And so what didn't exist before, i.e. platforms which enable real-time decisions, onboarding, and funding, now make this not only very cost-effective, but scalable. Another reason to think about, which I think is unfortunately an afterthought in many people's mind at this time, is that the receivables finance product is one of the few which has aligned itself almost perfectly with ESG. And again, just to make sure we're talking about the same thing, ESG are the environmental, social, and governance goals. So buyers are prioritizing early payment programs, green trade finance, where programs are tied to ESG metrics, are increasingly important. The next reason, and even though there's been some push towards nationalization, globalization and cross-border trade is not going to end. It may shift based on the supply chain, but what happens when we use receivables finance in international trade, it really helps mitigate or reduce the payment risk from foreign buyers, and it provides liquidity when needed for an exporter. The exporter gets paid faster, there's risk sharing, credit insurance is often involved. So it's really one way to mitigate some of those risks. There's also some accounting and regulatory environments which are technical, and I'm not going to get into the specifics. But again, some of the models out there or other products are becoming less attractive because of Basel and some other things off balance sheet treatment. But I think in summary, receivables finance should not be viewed as it has in the past just as a liquidity tool for companies in trouble. It really has evolved to a mainstream strategic instrument that can allow a corporate to manage capital efficiency, support their supply chain, and enable growth. So those are some of the underlying reasons for that.
Taking your words, it is now a strategic tool for the reasons that you mentioned, but also specifically tying into the ESG mention that you had. It connects to also SDG, right? So one of the SDG goals is to enable developing nations to be less beholden to grants by supranational organizations and be more self-sustaining. The way they can be self-sustaining is to an instrument like receivables finance, which allows the exporter to rely on a superior credit profile of the buyer. And this is something that we discussed in our initial, earlier session.
Yeah, it's
the chat
an
that we
excellent
had
point.
in prep. Yeah.
Yeah, that's an excellent point. As a matter of fact, McKinsey published this week, and I put on my LinkedIn blog or post that the estimated World Bank or IMF reduction in support for emerging markets because of what's happening in terms of nationalization is estimated between 15 and 21%. And so when you start to think that there's already an enormous trade gap, which I think we're all familiar with, when you take another 15 to 20% of the existing pool of capital out of that, somebody has to fill that hole. And the receivables finance product, especially in the emerging markets, is one of the ways which you can do it not only quickly, but as we'll talk about here in a second, because it's revenue driven. You get into markets like India and Africa and some of the Far East countries where there's enormous opportunity for growth because it's revenue tied, not bottom line tied or legacy tied. It makes it much more palatable and much easier to take on as a mainstream, again, product which will allow the company to expand. But yeah, I do think, and if anything, there's going to be additional fallout as or if these tensions around the world do not get solved in some reasonable short manner, because once that money has been taken out of the kitty, if you will, from funding from governments or others, the probability that it's ever going to go back is very, very remote. And so this is why the opportunity for receivables finance to support growth and expansion, especially in windows of market volatility, is very important.
Mark, we've, already flirted with, why receivables finance is important to corporates, as well as, strategically and from a fundamental perspective for countries as well. But if specifically, if we wanted to enumerate the benefits that a corporate accrues as a result of adopting receivables finance solutions, as well as how it supplements corporate growth, if we could have, more in-depth, I would say,
well, I think one of the
interesting, be wonderful.
Yeah, one of the interesting things about this question, which is not true of some other tools or options that corporates or SMEs have, it can be utilized by the smallest company, a startup, or very mature, very large Fortune 100, 500,000 company. And again, many of the products in the traditional banking model, such as a commercial loan or asset-based loan or lease, simply don't exist at the SME or startup level. And in our own firm, we really like startups because if you get in and build architecture first and provide, the client some guardrails, it seemed to have worked better than to get into a more mature company where you're always trying to undo something or redo something. But let me answer your question directly. The first and perhaps most important asset or positive about the receivables finance product is that it adds liquidity or cash without adding debt. And again, when you think about that's probably not much of an issue for a large established firm, but a small startup or in an emerging market, whether you're a day old or 1,000 days old or 10,000 years old, what it allows the SME to do is to convert unpaid invoices into cash. And more importantly, you don't take on any debt, which can obviously, impact the bottom line, the balance sheet, and other ratios. And equally important, because it's not a loan, it does not affect other debt ratios that may already be in existence. So for example, if there's a mortgage or some other type of asset-based loan, it preserves the capital capacity for the SME. The second, and I already mentioned this, is that unlike other traditional banking products, it can scale almost dollar for dollar with sales volume. So the more you sell, the more working capital you can access without requiring renegotiation of credit terms. So what that means, frankly, is that if you get the large order, maybe it's an export order or something, you can immediately convert that receivable or receivables to be liquid and have cash. And then you introduce credit insurance and some other tools into the middle, and it really works. And I think the third point, which goes hand in glove with this, is that in times of volatile markets, like I think we would all agree today exists, efficient working capital management is no longer an option. It's a mandatory exercise. And so how do you do that? One way is that you turn your receivables into cash faster. You shorten the cash conversion cycle. You make them more agile. And again, back to what you said, you're less dependent on third-party sources. It also makes your suppliers happy because when you pay them quicker, some of the stress that they are perhaps feeling from everywhere else in their supply chain, it goes away. And when you think about the need to support a supply chain, every one of these economic or political shocks that occur causes some type of cash flow interruption, whether it's a supply chain gets bogged down, there's a pandemic. What this product allows the SME or even the large size company to do is to continue to operate as much as possible on an ongoing, reoccurring, normal basis. But it also allows the owners or the managers of that firm to sleep at night. One of the most common validations we heard about factoring when we provided it was people said, I can sleep. I don't have to worry about getting paid. I don't have to run to the lockbox or the mailbox. And I think if you think about this, maybe perhaps on an offensive basis, too often we forget that in periods of volatility, opportunities for growth or acquisition occur simply because the firm is no longer, the potential acquired firm is no longer strategically or financially stable or able to continue to operate. So if you have stable cash flow from a receivables finance product, which you can turn on and off if and when you need it, what that can allow you to do is perhaps go into a new market that someone has bowed out of. Maybe you can go out and hire the talent that you couldn't afford or didn't want to. But the key is that because you have a steady stream of liquidity, you don't fall behind in R&D or maintenance or innovation because you're out of money. And again, from a competitive standpoint, the more one can operate as a business as usual in periods of volatility, the stronger they have to be relative to some of the other players in the market. One of the other accounting, and I don't want to get esoteric, but when you structure a properly structured receivable finance product, is typically structured off balance sheet. So what that does is that it can improve the return on capital employed because your operational metrics get better. It can typically improve a credit rating because you have higher liquidity and a lower debt to equity ratio. So again, from a strictly structural standpoint, not only do you have liquidity that you can turn on and off if and when needed, it helps you with your investors and lenders when you go to meet with them and try to renegotiate or have some kind of renewal. And then we already talked about this, but ESG is really important, and the receivables products are one of the few inclusive growth strategies because you have things like early payment programs that large corporates use to support smaller, diverse suppliers, and that builds a more resilient ecosystem. You have green financing, where many companies now are linking a receivables program to an ESG metric. And again, ESG should not be, even though it seems like in today's era it's an afterthought. This is one of the ways to continue to have it be a mainstream critical part of that equation. So in summary, what does it do? It offers receivables finance. It can be adaptive, it's non-dilutive, and it's scalable. And more importantly, it helps the corporate or the SME grow sustainably, competitively, and in it's respecting the planet. And I think all of those things become more important than ever because at some point we'll get back to a normal whatever that is, world. And the ones which have powered through the times of volatility are going to be stronger and better prepared than them.
So multifaceted benefits and, in fact, building on your response, I think for corporates that do not even have a credit rating, for example, right? This is a pseudo credit rating that you could get. So if you were not an issuer of a debt, if you do not have banking lines, let's say, for example, and if you were part of an invoice factoring program, that is a pseudo credit rating on you because somebody's conducted enough due diligence on your operations and your capacity to perform and deliver in order for them to onboard you onto this invoice factoring program. So, and that also ties in to the overall theme of resilience, ESG,
Right. It's a very
structural
good point
development,
because,
etc.
yeah, it also proves to the outside world or a traditional lender or government that you, first of all, have done your homework, that you've taken the time to apply and you've been approved. And while that may sound like a simple set of steps, the fact that you have been approved may make you 1 out of 100 or 1 out of 1,000. But it also, and this is really an important point, and perhaps the more established markets where oftentimes the SME will use their personal credit as the absolute sole source of capital for their small business. They use their credit card or their American Express card and they go out and get a line of credit or they travel on it. But what it does is that you can't, I guess you could, but you can't go out and get 50 credit cards. At some point, that's a strategy which has diminishing return and it fails. So what it maybe for the first time ever does is that it separates what is personal affairs from business affairs. And in order, especially for startups and SMEs, to prove that they're valid players in any market, that separation has to occur. And if it never does, all you have is then a sole proprietor masking itself as a corporation. And typically in those small firms, they don't go out and hire a team or they don't build infrastructure. They don't do the accounting the correct way. So if the SME and the startup is ever to take the leap from being a sole proprietor to a real organization, the ability to have outside financing, which a receivables-based product would certainly be one of the first places I would look, is really important.
I remember one of your statements from our earlier, warming session where you said to the incumbent that is prepared, this is a fantastic tool that gives them access to so many benefits. And I think, and that is what helps distinguish that prepared enterprise from the unprepared and the progression from an SME to a corporate.
Correct. Yeah, in many ways, it's like insurance when you think about it. You hope you never have to use it, but your house burns down or you have some calamity or you have an auto accident. It's nice to know it's there. And again, what makes the receivables finance product unique is that if you go out and get a traditional commercial loan, you pay principal and interest or maybe interest only every month until the note is paid off. If you go out and get an asset-based loan, the only difference is the collateral is an asset, piece of real estate, a piece of machinery, equipment. But again, you pay principal and interest, the rate is fixed, maybe attractive or unattractive, but you have taken on a debt obligation. If you go out and get an automobile loan or if you get a mortgage, all of those have fixed payments. The beauty of the factoring model is that instead of the bank or the financier being in the driver's seat, it properly structured the absolute person or individual who's in the catbird seat is the SME. Because if things are going well and your receivables are coming in quickly and you're cash flowing, whatever business you're in, service or product yourself, you don't need it. You don't use it. Our model is built where you only paid for what you took. And so in that case, your cost of capital or carrying cost is practically nominal. But the beauty of that is you're not forced to take something that you don't need. And oftentimes, in order to hit a goal or meet a quota, a zealous individual or lender may, tell the SME or the corporate to take more than they need. And as it turns out, again, structured as a traditional loan, it makes no sense to pay for something that you never use. The beauty of this, of course, is because, as I said, because it's scalable to the credit worthiness of the customer. This is really the only product which allows the SME to lever the credit worthiness of the buyer to their advantage. If I'm a startup and I get a contract to sell to Boeing or Apple or a government entity that has a high credit rating, I automatically attach my wagon to that star, and I get credit for having the sale being made to someone who's got excellent credit. This is simply not the case with most other products, because if you go in and look for a traditional loan, whether it be a mortgage, asset-based, installment loan, what they're going to do is they're going to look at the underlying collateral and make a decision based on when you're applying and what you're applying for, what it's worth. And you're only ever going to get a certain percentage of that at a certain point in time. And of course, the nice thing about this is that as you start to add on additional marquee clients and your portfolio begins to get more diversified, the credit pedigree of your clients helps you hopefully negotiate a better rate. Because if I sell to Boeing, and then I sell to Apple, and then I sell to Nike, and then I sell to, a multinational, every time I piece up that portfolio with an additional credit client, the risk to the lender goes down. And again, what's important to remember is that, if I'm a large factor or financier or commercial bank, and I'm supporting an SME who gets a large project with one of the Fortune 1000 or 5,000, I probably already have those receivables in my portfolio. I know exactly when they're going to pay. I know if they're going to pay. So the risk from the lender standpoint is really low, because they already have track record with many of the clients that you may be selling to, which again, this is the only product, if you think about the entire matrix of products which are typically available to a SME, this is the only product where you can lever the credit worthiness of the customer to your advantage.
And also, the leveraging the creditworthiness of the customer, the client, or the anchor in the parlance of the product is also doable now, more so in terms of management, because of the technological innovation that's taken place. And with this point, we segue into the next section of the questions that we have up for discussion, is the topic of innovation and technology. And we will see more adoption by corporates, by financiers, new types of financiers, because we now live in a world where a lot of things, operational burden is reduced because the advent of different types of tech solutions, and dare I say AI, not to overkill the use of that tool. So the question is two-part, Mark. The first one is, how technological innovations are transforming receivables finance for corporates is the first question.
Yeah, and so what's interesting is that historically, and even today in many places, the factoring or receivables model has been pigeonholed, if you will, into a mundane back office financing mechanism, which is poorly understood and rarely used efficiently. What it really is, if you think about it in a more macro sense, is it really can automate and create huge value by doing two things. It can lower the cost of capital to the user, but more importantly, it can, in most cases, help them become much more efficient. And what would be a good example? For example, when we factored, we allowed and always welcomed the opportunity to come in and provide services which we knew were done okay, but not as well as they could be within the incumbent or the borrower. So what would that be? For example, collections, lockbox, accounting, online reporting, credit insurance. All of those tools float around in the background. And as you said, these are only really available now because of technology. And interestingly enough, what's going to really transform and make this product even more attractive is automation and AI, because when you introduce automation and AI and you're able to streamline invoice processing, credit assessment, credit decision making, funding decisions can be made in a minute or 2 or 5 versus a week or an hour or a day. And what would be a good example? So for example, automated invoice validation. Think about if you had an algorithm that was properly set up where you could verify invoice accuracy, detect if there was fraud, which we'll talk about later, match the invoice to a purchase order. That would reduce manual errors and processing time. Another one would be risk scoring, and this is more on the end user, the buyer. But what AI already looks at historical pattern payments, it looks at buyer behavior, credit scores, macroeconomic indicators to assess risk. And again, all these tools are designed to not only make the decision making quicker, but better for the lender. And anytime they can lower their risk, in theory, the lower the cost of capital would be to the user. So already corporates are using AI to price early payments based on buyer supplier behavior. And again, making it so much more liquid. Another one, which sometimes gets, I think people have sometimes not a real clear understanding, is blockchain and distributed ledger technology. And if you're not familiar with it, you should be. But what blockchain does is it provides a secure, transparent infrastructure for trade and receivable finance and other products. But what it does is it reduces fraud, because once it's entered into the system, it can't be changed. And what would be some examples there? Smart contracts. So a smart contract automatically triggers a payment upon verification or delivery of, or if the invoice has been accepted. What it also does, and this is especially true in emerging markets, one of the absolute huge problems which plagues up and coming markets is the lack of some form of registration, where the financier is concerned that SME A is taking invoice 1 to 3 or 4 different financing sources and getting it collateralized, and obviously ending up with materially more than what they should. But what something like blockchain allows you to do is that it reduces the duplicate or fraudulent invoices by, again, maintaining a tamper-proof history of when the invoice was issued and who owns it. And again, these are tools which already exist and are going to become mainstream, because financiers are getting smarter and smarter and smarter, especially in the area of fraud, because the only more advanced technological brains that exist than the suppliers of the capital are the fraudsters. So in order to be 1 or 2 steps ahead, if that's possible, one needs to make sure. And then you get into other things like big data and predictive analytics. So what you can do is that you can literally use these tools to do forecasts. I can assure you, cash forecasting is probably done hourly in most corporations today based on what the news is yesterday or today, because of just what's happening with the tariffs and all of the trade wars. And so what it allows the treasurer or the CFO to do is constantly look at different predictive analytics in both its receivables and its payables, and they can make better decisions and decide who to pay and when. And then there's some other things like API. I'm not going to get into that, but one other interesting thing that we're seeing more and more here in the States is the entire concept of embedded finance. And if you're not familiar with it, what it essentially allows a one-click financing. So you sell a product, you go on a platform or some kind of procurement, and you can opt to finance at the point of sale, issuance, acceptance. This is coming and it's already here. And when you start to think about pre-approved credit lines as part of that platform, what it allows the SME or the party involved is to make sure they understand where they sit and how much liquidity they have if they need it. A related thing which I already talked about was digital identity and KYC invoicing. So one of the ways that this could reduce onboarding times and fraud is digital identity. And again, we're all moving to, an Apple Wallet kind of driver's license. And so the more and more this becomes mainstream in the consumer market, what the technology that's already out there allows the industry to do is speed up the approval process for a new supplier. And again, it's interesting when you think about it, all of those technological tools that make us smarter, faster, and more secure as lenders or as financiers. And so when you have that combination of unique tools come together, what it makes happen is that the financier is willing to step out and perhaps take on riskier, whatever that is, in their opinion, opportunities that they simply would never have considered in the past. This is very, very important when you think about this in the context of the emerging markets. Many of the emerging markets have very advanced cell phone and technological applications already out there. And unlike a legacy, more mature market like the United States or the EU, the party that figures out how to manage and harness and properly use all of that data that already exists on a cell phone or in a network like that, and they begin to apply it to an SME or a startup market, is going to be so far ahead, because all of that is data which is already exists, and the ability to quickly look at patterns of behavior, patterns of payment, patterns of non-payment, patterns of fraud in enormous amounts of data is going to be one of the ways which, again, technology is going to push this whole process forward. I did a program recently on data, and one of the points that was made is that there's going to be more data created in the next 3 years, primarily because of AI, that has been created in the entire history of the business cycle. And so when you start to think about that, the question really is, are we going to be prepared to be able to use quickly and efficiently and carefully all of this data? And it simply would not be possible without tools like AI and blockchain and others that are out there to quickly make decisions based on the amount of data that's coming down the road. Oh, that makes sense?
Kunjan, you are on mute.
Thank you for that.
No problem.
So, Mark, what the point I was making is this is so interesting, right? This could be a session on its own. We could spend at least 2 hours talking about use cases,
Easily.
AI, and data in the approval process that you mentioned, so that candidates that are, or rather corporate candidates that are worthy of financing, receive the financing that they rightly deserve. I just want to say that I see it from a two-part perspective, and this is more so because of the experience that we have here at 360 TF in dealing with the market. So when you apply technology to a product like receivables financing, there are essentially two aspects to it. One is post-approval, so when the facility has been granted, and then one is pre-approval. So that's when you're doing the origination, when you're doing the credit due diligence. In post-approval, the gains are immense. What you mentioned, the ability to detect, fraudulent invoices that have been submitted subsequently, because a bad actor, when they're applying for a facility, they're going to try to give you as good documents as possible. It's later on is when they start testing the system, right? They may documents, or they might dual use, etc. So many things that can take place. So technology, as far as the operations concerned, is absolutely fantastic in the way it's detecting fraud, and there are a bunch of solution providers that do that very, very, very successfully. But then,
I think 2 points there. I'll just quickly 2 points. There was an interesting article that I posted this week about synthetic fraud. And synthetic fraud, we ran into this several years ago in our factoring, where literally somebody applied having stolen some other SME's entire financial history. And the only reason that we caught it was because we did a routine check on application of calling phone numbers, a manual human interaction of calling phone numbers. And when we called the last one on the list, it was a lady in this case, had said, "What? I never applied for anything." And so, and if you haven't seen the article on synthetic fraud, it is exploding at the rate which I don't think any of us are prepared to deal with. The other interesting thing, and you make a very astute point, which is oftentimes you get set up in advance to be defrauded. So it becomes imperative that whatever due diligence that you have done pre-approval, that you don't drop your guard, because fraud occurs when the fraudster determines, as you rightly said, that somebody has let their guard down. They need a break. They need an over advance. They are in collusion with the debtor. But what I think is interesting is that we used to say this in our factoring office. We're being defrauded right now. We just don't know by who. Mm-hmm. And so it's always there. I mean, it's always there. It's a byproduct or a subset of the industry. But the key is that when you do this mechanically with a tool like AI or other tools, it never stops looking. It never stops asking the question. And if properly structured, those questions are constantly changing. You know, one of the things which is interesting that people don't think about, when we had a change of ownership in one of our clients, we immediately, in most cases, reran our due diligence, because when you think about a small SME, when one owner or owners leave, it's typically a fight over something, money. And when you start to think about that, the only source of income for most SMEs is their small business. And so maybe it's an issue of, you know, you could get into a whole myriad of different things. But the nice thing about using tools that are automated is they never stop asking questions. And that's the secret. Never, ever, even if the client's been there 50 years or 5 years or 10 years, what you said is right. The minute they sense that you have, you know, eased off or something has changed, that's when they pounce, and then it's too late.
And you know, what obviously it indemnifies or safeguards the financier in a post post approval way, but it also emboldens them to actually take on a case that they're probably not. So basically, or a traditional banker would look at a set type of profile, right?
Right.
But there are other players, because of this technology, because of the comfort that it can give you in terms of fraud, in terms of credit assessment, etc. Other players, other financiers that enter a market and provide the financing to the SMEs that perhaps a bank does not deem worth their time, if I will, to provide
that's
financing
right.
to.
Well, and if we think about the consumer market as a template, you go into a car dealer, they have a lender if you've got perfect credit, bad credit, indifferent credit, no credit. And each of those lenders has made a decision to be in a specific niche because hopefully they're good at it. And the person, the credit of the lender who takes on someone with no credit is going to have a completely different structure and cost of capital and collateral requirement than someone who's got pristine credit. And the real world, when you think about SMEs, especially, and true certainly with startups, is that the lion's share of them are trying to build credit. They don't have credit, which is the whole point. And again, if you had literally a rainbow approach, where oftentimes when we nurtured a startup, at some point they grew up, and we would help them get a traditional bank loan or some type of other loan. But again, there's an opportunity for the factoring and financier to still remain involved, because, as I said, what often happens, at least in our experience, was that the capital was the reason that they were attracted. The service is what made them stay. And so when you're doing an excellent job of looking at new customers, setting credit limits, getting credit insurance, doing follow-up collection calls, analysis, helping them cut down days outstanding, doing the lockbox and the accounting and the banking and all the other mundane stuff. Those are all really important tools that have to be done well. And oftentimes in an SME, the real world is that the person who's supposed to be making collection calls is the same person that does HR, that does payroll, that does procurement, that does compliance. And they typically work on things which are fires that need to be put out first. And it's an afterthought, unfortunately, for them to sit on a Friday afternoon and call people to ask them to pay their bill. And if anything, oftentimes what really works against them is that they have a personal relationship with the debtor, the client, and they're going to have lunch with them on Saturday or golf with them on Sunday. So of course they procrastinate, as many of us do, and say, "Well, I'll ask him then or her then," and they don't. And so it just gets prolonged. But that's again where automated tools. I'm sure we've all gotten the email or the text that says, your medical bill of $247 is past due. Oh yeah, I know. I'll pay it now. But that's where automation, especially as you get into what you said, this, the startups and the smaller companies coming up the line, can really help. And there's interestingly enough, there's, there even within the factoring space, and I'm sure in, the fintech space, there are niche lenders that only want to do certain types of transactions, and it's typically more industry generated because if you're an expert in transportation, you know what you need to make it work. Bill of lading and proof of delivery and all that. But if you're not an expert in it, that's also where fraud occurs, because the minute you dip your toe into the water and you have no idea what you're doing, someone's already waiting for you to take your money from you. So you've got to be very careful to make sure. This goes back then to education, which I think we'll talk about later, that, the most important due diligence or the most valuable predictor is a set of ears and a set of eyes, and properly trained, an inflection in a voice, in your client should be able to lead you to ask a question, I wonder what's going on. But if you have never built that relationship or don't have that rapport, obviously it's impossible to have that kind of information be passed.
Mark, these facets of technology that lead financiers to perceive less risk in a transaction, with that, risk thought in mind, when we're talking about corporates, though, what are the risks corporates should be aware of when they're engaging in receivables finance? And this could be this would necessarily be from a supplier perspective, right? So particularly around customer creditworthiness and the
Sure.
potential for late payment and non-payment, etc. So how could these be effectively mitigated, assessed?
Sure, it's an interesting question. The first thought is that there's a lot to be said for a second opinion. And so even if the corporate has a very advanced set of all the tools we talked about, there's no harm, no foul in seeking a second opinion, because what we found, for example, oftentimes the privately held larger company didn't have sufficient credit information in the marketplace because they didn't want to, or they didn't have to. But in that case, trying to set a credit limit as the financier was difficult. So oftentimes we partnered with, for example, a credit insurance company that had access to financial statements because they may have been writing the D&O or the E&O or something else. But I think I have a list. Let me go through. Customer credit worthiness. Obviously, this is one of the most important, because the ability to have a second set of eyes or additional information look at the financial health of the buyer, and then also take into account unfavorable macroeconomic conditions and other things, is really important. And this is where credit checks and credit monitoring comes into place. And again, there are credit rating agencies. There's a huge market now for AI-powered risk analytics. But again, the important point there is you're having an outside third-party source essentially confirm what you already know. The second risk, of course, in that whole discussion is late payment or dispute risk. And this goes back again to where looking at prior history and then looking at current case, information, you can pretty easily look at disputed deliveries, unsatisfactory service, non-compliant or inaccurate invoicing, payment terms which were not clear. if a financier is involved, they're going to force the SME or the corporate to make sure they have quality controls in place. And what are those things? Automation, digital platforms. If the invoice never gets out to the right address on time and is accurate, it's never going to get paid. And so this is also why the financier is going to come in and hopefully do due diligence on the simple block and tackle stuff that needs to occur. The other interesting thing is that when you have a third party involved and there's a dispute, I mean, they're not going to wait around in most cases for the badgering back and forth to, eventually make the invoice get paid. They're going to, force the resolution to it and come to some conclusion, which again, it only could be 1 or 2 out of 1,000 or 100. But, if it's a large dollar amount, which they typically are, you have to get those things resolved. Fraud and duplicate invoice risk is obviously the large issue here. And, from the financier's perspective, duplicate invoices, fake invoices, collusion between client and debtor, are the worst case scenario. So what causes those? Poor internal controls, maybe a manual invoice processing, maybe there's weak due diligence. And this, again, we go back to not only technology, but human verification. When we have AI or blockchain that can validate invoices and prevent duplicates, that's a powerful tool, which perhaps in most cases, smaller and maybe even some corporates don't have access to. But, the related part of that equation is dilution, which, again, if you're not familiar with what that term is, it's, an invoice which was issued for 100 because of rebates or credit notes or returns or some kind of co-op gets marked down to 70 and you finance 80. So obviously there's a shortfall. So again, this is where having accurate information on post invoices adjustments or returns and reading the contracts to make sure you're not getting involved into a hornet's nest is really important. And any financier worth their salt is going to look at historical dilution trends, but more importantly, they're going to look to future ones because it's, they're not financing the past receivable, they're reducing the one that's issued today. And so if you're the financier, how do you, protect yourself or mitigate some of that risk? Well, maybe you set up a reserve or you set up a lower advance rate, but you only can do that once you've taken the time. And again, this is something much like fraud that has to be constantly looked at, and you can never stop asking questions because just because they paid the invoice in time and in full on the last project, there's no guarantee that project 2 or 3 or 4 or 5, and if anything, corporate America probably takes advantage of the naive nature of SMEs, who land a big project, who get into it, they realize this is never going to work because by the time they absorb all the chargebacks and the other costs, it's not going to be profitable. And so there are some other things which would be legal. Again, one of the things which we would tell people, especially who got into cross-border transactions or very complex transactions, you must have competent legal, tax, and accounting help to make sure you understand what you're getting into. You can't take the attorney who does mortgages on the side and have he or she read the contract to protect yourself. And if anything, especially in a period like we have now, where, just think about someone trying to track what is payment in full on an invoice in a country that has multiple tariffs, maybe rescinded, now back on, back off. You better make sure that you have really competent, not only internal help, but, external help to make sure you're paid in full. And the other one would be, and this gets into the weeds perhaps, but you better understand the operational risk within the client. This is regardless of size, because oftentimes I think, at least we did, you make assumptions that based on their size, that their systems are accurate, their internal processes are efficient, they have backup documentation to protect themselves. You should never assume any of that. And if anything, when you think about it, the inability to be able to collect the invoice is often driven by a manual error on an invoice, or a submission of only part of the invoices where part of them are missing. It might be poor training, or it might be internal fraud. So what you really have to make sure is that the tools that they have and they're using, are accurate. And one interesting thing, and a final one, is that most people don't think about this, but there is something which I would call reputational risk, which is, in as much as it's important to be on top of your game, the last thing you ever want to do is have anybody be aggressive in trying to collect an invoice. And if you think about it, for a company that's struggling or a company that's up and coming, one bad phone call and screaming at somebody, the customer relationship or the supply relationship in that case, may disappear quickly. So this is why in many cases we were asked and would take on the job of doing the collection on some or part of the receivables, because from our perspective, we're an independent, indifferent, third party who simply wants to get paid. And, when you bring a sense of order and a sense of professionalism into that equation, the practical reality is oftentimes what they said they did in terms of follow-up has never been done. And so as a result, part of the challenge is to build infrastructure at the beginning to make sure that you know what controls are there, what technology is there, what their credit policies and procedures are, and you can somehow mitigate most, if not all, of these problems.
So, Mark, this question, or rather the answer to the question that was asked, that whether the corporate can get a secondary comfort from an external party on the creditworthiness of the buyer, right? In a way, that also helps the client, the supplier in this case, to understand whether they want to get into recourse or non-recourse financing terms. And that gets into the second, or rather the last phase of our dialogue today. And since I think we started a bit late because we had some technical difficulties, we have 5 more minutes before we open up to questions from the viewers. But so this is a question: what factors influence the decision between recourse and non-recourse?
Well, it's interesting. One of the factors that influences that is what's available in the marketplace. And interestingly enough, I write with a colleague the World Yearbook for FCI and BCR, and for example, in the United States, the vast majority of the financing and the choices. Let's back up. The choices are recourse and non-recourse, and recourse is where obviously you have some what it said, the word recourse, and non-recourse is where you wash your hands of it. But interestingly enough, the data that just came out yesterday from FCI on a global basis shows that the vast majority of the factoring that's done or was done last year was done on a non-recourse basis. And non-recourse means once you've sold the invoice, it's somebody else's problem to pick up and run with it. But I think part of it also then gets into not only recourse and non-recourse, but the type of lender or financier that you have. Because obviously there's a huge number of very good banks that are doing this. There's a growing number of very good fintech and startups. But in terms of where you go to get financing, really, I think you have to look at it on a pro and con basis. If you have an existing relationship with a bank that you're comfortable with and they have all your information and they've been great servicers and all of that, oftentimes your best bet is to go there. So for a large creditworthy corporate with an existing banking relationship with a conservative risk appetite probably makes sense. That being said, there's an entire planet of alternative providers and digital platforms. That could be a fintech, it could be a marketplace. They often can move quicker, faster, cheaper. The important thing there is absolutely, positively make sure that you do your homework. And you do your homework not only at the beginning, you do it before, during, and afterwards. Because what you see and what you end up with may be totally different. And then, of course, as you mentioned, recourse, just again to confirm what we talked about, the seller remains liable for payment or lack of payment, if you will. And obviously the advantage there is that, you know, it might be lower cost because you continue to carry the credit risk. You know, the risk is obvious. I mean, if the seller doesn't pay you, it's trouble. And then the non-recourse is where you literally hand, if you will, the risk of, you know, of non-payment. And the key here is to make sure you understand what triggers, you know, that to occur. Is it insolvency? Is it bankruptcy? Is it a dispute issue? But it's very important. And so this question, again, we could probably do 2 hours on this. So what you really have to do, I think, is look at a holistic matrix of cost, what your risk appetite is, how technologically ready you are to deal with, for example, trying to recover, you know, invoices yourself. And again, you know, the right mix comes down to what's your preference. And again, in certain markets, there are not many options because the industry hasn't grown to a point where there are more than a couple. But again, what's like the point I can't make enough. Before you ever enter into a contract of any kind, do your homework, do your due diligence, ask for references, call them, verify them, validate that what you see is what you get, especially with a startup or a newer company, because the last thing you want to do is get involved with someone and, have them be unable to meet your need. Is, the old saying goes, it's not where you start, it's where you finish. And so if you anticipate growing rapidly, make sure that first of all, that they have the capital to be able to drive the bus, but you have to really, really do your homework. And again, I think what occurs is oftentimes people do it, pre-signing and then, don't do any post-signing. But on an annual basis, at a minimum, you ought to be asking questions like, how would we rate our relationship? And, is this work for us? And are other cheaper, better alternatives out there in the marketplace? Because again, you can never, ever do enough due diligence when you're borrowing money or factoring with an outside firm.
Golden words, you can never do enough due diligence.
Ever. I mean, ever. Even when you think you've done it all. I mean, the question you ought to be, like Einstein said, never stop asking questions. That's the key.
And on that note, the final remarks for our dialogue is, what is the future outlook? What are the trends you foresee shaping the future of receivables finance?
Well, I think, this is a really interesting time for our industry because we have the opportunity to really step up, because in historically, at least in the United States, and we started ours in the year I did 26 years. So I mean, we saw several recessions or near depressions and COVID and a bunch of other things. But I think we have the opportunity, for all the reasons that we talked about, to step up and fill a huge void. And there are two kinds of voids. Number one, part of it is in the emerging markets where you simply don't have the entrance yet to come in and provide the capital. But the second is to take, and work with both corporates and SMEs to realize, as we mentioned, this is not the lender of last resort tool as it, used to be. Properly used, there are opportunities to strategically really completely upend and change for the better the organization. But, the trends, well, I can think of a couple. One is clearly digitalization, and real-time finance. It's already here. And so if you are either not doing it yourself, or if you are not technologically aligned with the partner, I mean, you better be, because the bottom line is the end user is as impatient as ever and getting more impatient. And if you can't produce the kind of results in a relatively timely and accurate manner, and then you think about things like embedded finance, where it's going to, the B2B is going to have an entire universe of opportunities in procurement, invoicing, ERP, e-commerce. It's already come through in consumer finance. And it's only a matter of time before somebody says, why don't I have the ability to have 6 or 7 options? And if the traditional factoring or financier space doesn't step in, then a party like Amazon or someone who's got enormous amounts of data already sitting in a database is, not logical. Yeah, we didn't really talk about this at any length, and I think we mentioned it, but ESG metrics, I think, are going to become a central part of decision making. Maybe not so much because in the United States, it's a little different than Europe and the EU and some other places. But I hope that as part of the due diligence process that a financier will do, that we reward the SME or startup or corporate for behavior which we want. And why? Because, the more we reward sustainable behavior and improve supplier diversity and meet, zero carbon limits and social goals, the better off everybody is. And, for the first time ever, perhaps it recognizes that we need to look just beyond the bottom line and, finance, have tiered financing based on scores, which, there's a lot of debate about the accuracy of scores and that, but the simple fact that you would call somebody out and make them aware of it is half the battle. And again, this is really an issue, I think, with SMEs, primarily in the United States, who don't have the staff, don't have the attitude, if that's the right word, to take this seriously. But I think we need to take it seriously because we're all in this bucket together, and we need to design ESG aligned, receivable finance programs. The more we reward and track and report, the better off we're going to be. And then part of it also then is, how do we outsmart the fraudster? And this is a never-ending process. I often laugh and say we should hire the people that defraud us to come work for us, so we would know what's next. But I think if you think about everything we talked about, there are three, I think, pieces to the future. It's going to be more digital. It's going to be more dynamic, primarily with the introduction of new players and startups and fintechs, and purpose-driven. And I think the purpose-driven is really the ESG function. And I think if it's really ever going to find its true utility value, until we reach a couple of things. Number one, we shift our mindset from using this as a reactive cash flow, I need money tomorrow, to a strategic liquidity orchestration company-wide. We will never take full advantage of the opportunities we have. And then the second would be to align the receivables finance, and I said this already, with technology, with the ESG commitments, and look at it more on a global basis. We can impact a third world country by our selection of a supplier. And if we begin that process now, and rather than wait for somebody else to always do it. It gets talked about a lot at the Fortune 100, but the practical issue is the lion's share of the work, if you take out the big companies, is performed by the SME. And when we begin to think about it not as a funding tool, but as a growth engine, a resilience builder, and I guess the term I would think probably would be most appropriate, like an ESG amplifier, we can accomplish things which we simply have not done so far.
Strategic liquidity optimization, that's what you said, organization.
Right,
and with those
right.
words, yes, go ahead, Mark.
No, I think, but I think this also goes back then, and we talked about this in our prior call. Part of this also is making sure all of these tools are wonderful, whether it be AI or blockchain or what we do or any of it, but without the proper personnel and training and reskilling that we need to do, we're never going to take full advantage of the tools that we have. And you can give, if you give someone the highest performing computer and they can't figure out how to turn it on or how to make it work, it's money down the drain. And I think this is especially true as we now move into an era where people are asking questions will my coworker be an AI chatbot, or will I report to a chatbot? And if I think as employers, we need to step back and ask ourselves: have we done the adequate training we need to make sure that the employees that we have are using the maximum brain power and skill set, and are energized and are motivated to be there? And if you look at the data from McKinsey and Gallup, 75 to 80% of the people who go to work every day are indifferent or could care less. And if we only move that marker to half, assume it's right, think about what could happen. You add to that tools which they understand and are not afraid of, like AI, the productivity and the performance would go off the charts. But I think in our rush to all use AI, I dare ask the question: have we ever really thought about our existing workforce with the same kind of thoroughness or concern? And I wonder sometimes if the answer is where we get more enamored with the bells and whistles than the basic block and tackle, which is, do we have people that are coming in working hard and again, enjoying what they do, and have that filter through the results of what they do on a daily basis, so they have a meaningful experience when they come to work. And that's a whole nother conversation for a whole nother day. But
Well, on that note, Mark, thank you so much for the discussion. We're now open to questions from the listeners and viewers.
hopefully kept them all awake. It's early in the morning, somewhere.
Yeah. Thank you to our panel for sharing their expertise with us. Now let's have a look at the questions. So we have this question from our attendee named Virendra. What are the charges currently in UAE for receivables financing, like processing charges and interest charges?
So I'm not sure I got the first part of the question. Can you repeat it?
Yeah, sure, I can do that for you. What are the charges currently in UAE for receivable financing, like processing charges and interest charges?
Okay, so I readily admit I would be over my head in trying to answer a question specific to a certain market. What I would encourage, and this is an interesting question, because one of the reasons I think why, at least in the States, factoring has never blossomed in terms of percentage of GDP like it has many other places, like in the EU and the UK, is that we have never had full disclosure or transparency here in the industry, period. And as a result, people often are misled, and it's misunderstood. And only after they get into the tub do they realize that the water is warmer than they thought. So I would answer that question this way: any provider of a service should be able to give you in writing every charge that would ever be possibly assessed, and actually run through. And what we would do is we put a calculator on our website, and the calculator said, you're going to finance $300,000. It's going to be out for 60 days, and we would give them a range of relevant rates, because I don't think anybody would give a specific, to the point X basis points. But any credible firm should be able to provide you that information, because here's the bottom line: if the financing cost is so expensive that you strangle your customer, this will never work. And one of the things which often amazed me is that when I would call on people and they were looking around, I would ask a basic question, which is, what do you pay now? And more times than not, the answer would be, I don't really know. I would say, how don't you know? Well, I've asked several times. They've sent me some information, some spreadsheets and all this, but anybody worth their salt should be able to tell you and provide you not only those kind of costs, but any other charges. So in the States, there's when you borrow money for a mortgage or a car, there's essentially a cost of capital sheet that's attached to the front that says, here's what you're paying, here's what it is, here's the effective APR. any provider of this, especially in a bank, should be able to provide you the exact same information, because absent that, number one, it's impossible to compare. But number two, oftentimes the correct decision is not the cheapest choice. And when we marketed our services, I often said, I mean, if you're looking for the low cost provider, I'm not sure we're going to be the right party, but let's see. Because in every respect, at least in my opinion, when you enter into a relationship like this is not a transactional, overnight type of thing. This is a relationship that you need to work at and build together, and eventually get to a point where, because of the success of the borrower or the factored invoice in this case, that you can lower their cost. Because I view this as a relationship, a personal service relationship, and we did everything we could in our power to make sure, number one, they understood. Because again, the practical issue is, if you quote somebody 10 and the first time they figure out it's 14 or 16, the duration of the relationship is going to be, it's done. And trust is absolutely the most important piece of any relationship. I don't care what kind of relationship you have. And you build trust by doing the right thing over and over and over on time in a mundane, manner. But again, the other thing what I would do, and I don't know if they have it in countries like that, but one of the other challenges here, at least in the United States, is that for the first time ever, about 7 or 8 years ago, Pepperdine University has a capital markets project, which I have a degree from there. And what we would do is that we would get all the financiers, not all, but we would get a pile of financiers to submit all their pricing information, structure, cost, out of pocket, volume, dynamics, everything. And then Pepperdine's Graduate Business School would produce and then publish sort of I don't know if you have them in India or in Dubai or elsewhere, a Kelly Blue Book, which is essentially a cost of capital book. And what it allowed SMEs then to do is to make an educated decision about what they were getting into. You wouldn't buy a TV or buy a car without, going to some third-party website and figuring out what it should cost, right? And yet people would
and scouting the prices. Yeah, absolutely.
Exactly. Yeah. And people would make
Yeah.
franchise decisions on financing without having any idea whether they were overpaying or underpaying. It's not a way to make, it'd be like going to a supplier and say, I want to buy 10,000 widgets. What do you want? What's the cost? What do you want to pay? Well, no, what do they cost? It'd be going like, I'm sure we've all been to a market where, you have, there's no prices on anything. And so you don't know. But no, that you should be able to be in a position where you make an educated decision. I don't know. I'm sure FCI does not publish this. And in all the years that I've ever been in this, I don't think I've ever seen, a published document about what prices, this runs in terms of. So much of it would also be unique to the market. The cost of capital. Yeah. I'm sure the cost of capital. Yeah.
Sorry, I think I'm talking over you. Tying up your response and, and to the person who has asked the question. So exactly, it's market specific, but globally, processing fees for investment grade countries are between 1 to 1.5%. For non-investment grade countries, they're higher. The factoring interest, as Mark mentioned, is a function of the market you're in, but there's always a reference rate. So the reference is going to be a SOFR or any other type of bank-like borrowing rate over which you have a credit spread. That spread is based on the credit evaluation of the borrower or the supplier. So that's
if you really question. Yeah, if you were really into the math, you could probably work in reverse by taking a middle market company that is publishing annual reports publicly and look to the footnotes. Well, when we started, this is a long time ago, we looked at what the best companies in the industry were paying in terms of financing costs, and you work backwards. And obviously, as pedigree declines, And as risk increases, the cost should go up exponentially, not exponentially, but it should increase dramatically. But again, the other part of it is, when you talk about pricing, it's much more than what you're paying today. How long is the contract for? Are there termination fees? Are there closing fees? Are there non-borrowing fees? Are there due diligence fees? Are there audit fees? I mean, you really, really, we would often, and I always applauded, we would have people contact us and say, I'm going to send you a spreadsheet of every cost that I think you might charge us. I want you to fill it out and send it back to me. I'd say, fine. And this is typically when a fractional CFO or in bankruptcy, a third party was representing the potential factoring client. And that way, we always encourage, I absolutely encourage you to get 3 or 4 quotes. I encourage you to do due diligence. I encourage you to go meet them. I encourage you to get a sense of their attitude or their dynamic or their personality. Because again, if you're looking at this as a relationship as opposed to a transaction, the non-financial variables make an enormous difference. And how they treat you.
Absolutely.
Yeah, so
that's key, right? The
exactly
relationship and how you're treated.
That's right.
And I think we have some more questions, and also perhaps a few more minutes to go, so we can get to the rest of them as well, Akshata.
Okay.
Yeah, thank you, Mark and Kunjan, for answering it. We'll take up the questions ahead. Probably Mark will share that with you and Kunjan to answer it, given the time. So, yeah, we extend our heartfelt thanks to our esteemed panel for sharing their invaluable insights and expertise during the webinar. Thank you to all our attendees for your participation. We hope the session provided valuable takeaways and inspired new perspectives in the world of trade finance. Now, get ready for the 5th episode of Season 2 of our Business Unplugged series, featuring Dr. Anil Khandelwal. Mark your calendars for 18 July, same time, same place. See you there. Have a great weekend ahead. Thank you, everyone. Thank you, Mark, Kunjan, and the attendees for joining in.
Thank you.
Thank you.
Yeah, thank you.
Thank you. Bye-bye.